接下来，让我们把视线转向欧洲。虽然特蕾莎梅2天前才显保首相之位，但是英国脱欧进程面对的仍然是一波三折的局面，而法国、意大利等国的乱局又必将对欧洲经济造成深远影响。那么，作为投资者，我们应当如何应对？下面有请圣宝集团首席经济学家、首席投资官 Steen Jakobsen 先生从一个欧洲金融人的角度带来他的分享。Now let's welcome Mr. Steen Jakobsen, Chief Economist and Chief Investment Officer of Saxo Bank, to share his economic outlook on Europe.
Ladies and gentlemen, it's a great honor to be here today. Now we need to look into the future. To predict the future, we need to understand the history. The history in 2018 was very much about what I call the Four Horsemen. The reason we had a bad year in 2018, I know this, 95% of all dollar assets in 2018 have a negative return. This is the first time since 1994. It's also the first year where a 2-year Treasury bill in the US outperformed both the bond market and the stock market. So something significant happened in 2018. What was it? First of all, we need to understand that the world today does not have any business cycle anymore. You may go to university or business school and learn about the business cycle, but the central bank took that away since 2008. In its place, we have a never-ending credit cycle. So the 4 things you need to put into an economy at all times when you lack the productivity is the Four Horsemen. The quantity of money, the flow of credit into the economy is the lowest we have seen in decades. We can call it the credit cake. The credit cake is getting smaller. Not only is the cake getting smaller, but the individual pieces is also getting more expensive, partly because of the Federal Reserve of the US having an extremely hawkish monetary policy. An unusual hawkish monetary policy because the steepness, the speed with which interest rate has gone up in 2018 is almost unparalleled since the Second World War. So the credit cake is smaller, and every single piece of the cake is more expensive. It's also more expensive to produce the cake because the price of energy for the average of 2018 is very high. And finally, if you want to sell this cake to the rest of the world, the globalization is also under pressure. In other words, ladies and gentlemen, we've had the worst year ever for a credit cycle. And this is seen by this chart very, very clearly. You can see we are breaking to negative in terms of the credit stimulus in the world, only matched by what we saw in the early 90s and in 2000. And you know what happened at those days. Stock market collapse and a re-engineering of the policy response from central banks. We are also concerned with the speed of the rise, the price of the money. As you can see from this chart, the speed has been extremely aggressive, and it's led by a very pragmatic central bank governor in the US, Jay Powell. I think the best thing about Jay Powell is that he's not an economist. He's actually a lawyer. And his policy seems to be, Jay Powell, the Federal Reserve of the US, will continue to hike interest rate until either the economy goes into recession or the stock market collapses. But in choosing such a strategy, we also know when the Federal Reserve will stop hiking interest rates. So the first thing I will interpret for you today is the fact that when, like yesterday, the stock market closed at the low for the year, we are very, very, very close for the Federal Reserve to stop hiking interest rates. I actually think that the hike that probably will come in December will be a very dovish hike. It will be one bridge too far for the monetary policy in the US relatively to not only the domestic growth in the US, the size of the credit cake, the price of the cake, but also the global environment. Because this very tight monetary policy has also meant that emerging market, China, and all of the other growth engines of the world have been impaired. I happen to think, not because I'm in China, but I happen to think that the most important central bank in the world is the PBOC. I know everybody, at least in the Western world, spent 98% of their time trying to read the tea leaves of what goes on at the Federal Reserve. But ladies and gentlemen, let's be honest, we know what happens all the time in the US. A little bit of trouble, little bit of challenge, and they cut interest rates. The PBOC, on the other hand, as we have already heard in great length and with great expertise this morning, has a more difficult task. Slowly opening up of reforms. How do you manage stability in this environment? But the PBOC, or China overall, is 35% of the credit cake in the world. US is only 18% of the credit cake. In other words, what happens in China is more important economically, credit-wise, than that happens to the rest of the world. So in the case of China, we actually know that the monetary policy is easing. And I will say to you today, we will have at least 2, if not 3 cuts in the RRR. We will have, in my opinion, very soon, a personal income tax and further fiscal spending. We will have a monetary policy that will lead to a stronger renminbi, not a weaker renminbi, as a way to play into the trade impasse there is between the US and China. But the good thing about analyzing markets and economics from the point of credit is that credit leads the real economy by 9 months. In other words, the front page of your newspaper today, in credit terms, was created 9 months ago. So if you want to understand why the stock market is trading at the low of the year, you only need to find the newspaper from 9 months ago. But if we know that the credit cycle leads by 9 months in terms of economic activity, we also know what will happen in the intermediate future. When we look at that econometrically, we have an explanation value of about 60 to 70%. So put differently, I know with 60 to 70% of the incoming data what will happen for the next 9 months. I do not know whether there's going to be tax cuts, fiscal spending, and other things that will mitigate some of this risk. But in terms of the credit, it is very slow in terms of moving through the economy. But if we look at China's amplitude going up and down, we can see there has been a very tight monetary credit impulse since 2015. But what's interesting is it's already seen its low. which means that the next impulse from China will be asynchronic, very different from the rest of the world. So again, like in 7 and 8 and 9, China will lead the world in terms of expanding the credit and monetary easing that goes on in the world. But to understand the magnitude of the tightness and why 94% of all dollar assets this year is negative, you only need to look at this chart. As you can see, if you look at the credit cake, then what we have right now is the lowest, the smallest cake that we've seen in multi-decades. It's actually lower now than it was in 2008, 2009. The ability to reverse some of that, of course, is less potent than it was in 2008, 2009, because China, like everybody else, has increased the total amount of debt that it uses to create GDP. The monetary easing will continue in the case of China. I see significant easing incoming, in particular before the Chinese New Year. But if we look into 2019, this chart is very interesting because, as I said, if the credit impulse is changing and has been changed over the course of the last quarter, then we know inside the next 1 to 2 quarters, then the credit impulse will turn upwards again. So if we take this credit impulse and advance it 8 months and put it against the manufacturing PMI in China, you can see very clearly that as we come into early parts of 2019, we will see the low economically and cyclically in the Chinese market. I personally think that will coincide with the low in the stock market as well. So I have now defined 4 things that are negative. What can change in 2019? I mentioned one thing, China. China becoming more aggressive, cutting interest rate, cutting RRR, personal income taxes, rebates to the consumption. But look at this. This is the Federal Reserve's likelihood of increasing rates in 2019. In September, the market was expecting 2 hikes from the Federal Reserve in 2019. As we speak tonight, it is 0. So in the space of 2 months, the perception, the hawkiness of the market has been replaced by other bearish negative environment for the markets. So when the Federal Reserve stops hiking interest rate, probably after the December hike, we will have support for a weaker US dollar, for commodities, and in the process, emerging market and China. So what is going on right now is that the credit market in the US is falling apart. The ability to refinance has become extremely expensive. And a lot of Western banks like Santander is putting out their 2019 outlook. I don't know if you know the movie Home Alone, but I don't think the guy felt very happy about being all alone with the parents on holiday. So maybe 2019, the credit market will be left home alone. So what have I just told you? I've told you that the credit cake has collapsed. The credit facilitation is very low. Fed will hike in December, but stop in 19. US has cyclically peaked. A lot of it has been an extension in time, created entirely by one of the worst administrations ever in US history in terms of understanding economics. Fiscal expansion late in a business cycle. Tax cuts, that was almost entirely used to inflate the stock market. For the first 3 quarters of this year, the US stock market was flying. Was it flying because the US company was better quality? Was it flying because they had better management? No. They were good, they were excellent, the profit was fine. But the majority of the moves was created by the tax reform that was instituted last year. In that process, it was allowed for American companies to repatriate, to take home all of their overseas earnings. So what the US companies did was to take $2.7 trillion from the European banking system onto the onshore American banking system. $2.7 trillion came home to the US. It compressed the credit spreads. But more importantly, $1 trillion was used to buy back the company's own stock. They were reducing the amount of stocks available for the public to buy. We created a momentum frenzy to buy stocks. And now to Europe. I think it's interesting that 6 months ago, Mario Draghi, the ECB president, announced to the world that we had finally come out of the crisis that was created and started by Lehman. At this week's ECB meeting, he said that quantitative easing was, for many countries, the only thing that kept the economy going. That's in the space of 6 months, he came from QE works to QE does not work. We have a risk in Europe that in 2019, Europe will go into recession, having negative interest rates, and a massive quantitative easing program in place. Not exactly evidence that in a business school like this will make you graduate. But as you know, central bankers, politicians, bureaucrats are not exactly known for being pragmatic. In terms of Brexit, I don't think there will be a deal by March. Because how can you do a deal with someone who doesn't know what kind of deal you want? So I will say, with a smile, ladies, it's a little bit like talking to my wife. I know she wants something from me, but I'm not sure she knows herself what it is she wants from me. That is the UK. It is the most likely that we will have an extension of the time period in which the UK is negotiating with the EU. It is also likely that we will have a second vote. It may not be a vote entirely about whether they are going to leave or not, but it will be more likely a vote on what did we actually say when we said no. Again, I can only think of talking to my wife for the same situation. But what the problem is in the UK is that if we look at all of the credit cakes in the world, the biggest reduction in credit facilitation is in the UK. So while, as you can see from the chart, when we had the Brexit, we had some of the most supportive credit facilitation going on in the UK. So the fallout, the negative consequences of Brexit was not experienced before now. But as we go into 2019, we will not have a deal by March. We will not have a deal by end year. but we will have one of the biggest contraction in the UK economies we've seen in history. Italy, being a European, and if there's any Italian in the rooms, I will say sorry before I say the next sentence. But there is not a single Italian anywhere in the world who wants to reform or change. They do think they are the best in the world in everything. And that is true in food, in art, in a lot of things. But economics, they are not even playing in the first division, the second or the third. They have zero interest in changing. So the present populist government in Italy wrongly thought that they could challenge the EU by increasing the amount of fiscal deficit they have in the country. It was pretty much game theory. The theory being, we will seek a confrontation with the EU. If they back down, we can sell it as a political victory at home. If they are not backing down, we can announce another election and try to get a bigger vote support for our program. But the Europeans have a little bit of experience of doing this with Greece and Spain and Portugal. So what happened was that the EU just allowed the Italians to talk and talk and talk. And to be honest, that is one thing the Italians are very good at. But what happened was that the BTP, the Italian government bond yield, continued to increase and increase. And let me say this, every single country in the world will be bankrupt if interest rate would be trading at 400 basis points. So Italy could not afford it, and what we saw over the last 2 weeks has been that the Italian government has caved in, and Italy for now is contained. So let's go to what I see happening in 2019. I have talked again and again about this cake, so much that I'm actually getting hungry. But the credit cake in the world will turn in Q1. But what is also interesting is that you can use the credit facilitation to predict the future value of the dollar. As you can see from this chart, with a 60-day lead, we can predict that the US dollar will peak somewhere at the end of December and early January. Again, this is not a profit machine, so there are risks to this. But the best indication is that the peak of the dollar is very, very close. So what I say to close it up is the following. Everybody in the world all of a sudden are very concerned about economics. The same people that 6 months ago declared that the world was already way past the great financial crisis. Having done this job for 30 years, and yes, I know I look much younger, I only know this. When 95% of everybody agrees, it's time to look for the opposite. What I think will happen is, as I show here, that the low in terms of both economic, the markets, and the political cycle will come in February, which of course coincides with the New Year in China. What I think will happen, and in my forecast for 2019, I will say the following. I think one of the strongest currency in 2019 will be the Chinese renminbi. I think the Chinese renminbi will trade from 690 today to about 660. Why? When you have a trade impasse with the US, the one thing that they understand, one thing that will have respect in the US will be for a stronger currency. as it was eloquently explained earlier in this session, a stable renminbi also fits the government's overall strategy. If you then add to this that we have a US monetary policy which will stop being hawkish, turn to first a holding period, a pause, and then to negative, then you will see a weaker dollar in the dollar CNY. And finally, I think, unlike everybody else, it seems that the Chinese government, with its commitment to opening up a reform with Chinese characteristics for the next 30 years, is going to open up, create more competition, and facilitate a higher consumption rate. My credit cake is already indicating it. Now we need to see the confirmation. The second thing I will say as a trade for next year is to be overweight the Chinese stock market. We at Saxo Bank has been selling US equity and buying emerging market dollar-based MSCI risk. Our favorite long markets are the Chinese, where I think Shanghai Composite have seen the low. We also like India, we also like South Africa. I don't think it's time to be outright increasing your exposure to the equity market. As I showed before, I think that February is the low. But for me, for a lot of risk allocators, buying China constitute cheap value. So number one, a stronger CNY. Number two, an overweight into emerging market. And number three, I want to be long gold. In a world where we have less inflation pressure because of energy, where the dollar is peaking, where the global environment is one of risk, I think we can easily see 1,400 in gold. Underneath that, of course, I also like the mining sector. My biggest negative positions will be in Australia. I'm just come up from Sydney. Sydney is the most leveraged economy in the world. And in the course of Q1 and Q2 in Australia, you will see massive amount of defaults. You will see no mortgage origination, no new creation of credit, because all of the banks is under attack. And then, as I said before, do not belong the sterling US. UK sits in front of the worst 3 to 6 months they have experienced since the 1970s. So, to end up, Saxo Bank every year does 10 outrageous predictions. And this is not our official forecast. What I think is probably the most concerning is Prime Minister Corbyn sending sterling to 1. But I am sure a few people will want to understand why we think Apple will buy Tesla. So what we are saying, with a smile, is that Apple will make a tender for Apple at the price of $520, which, by the way, is $100 more than Elon Musk got from the Saudi Arabian government. The point here is a different one, though. All car companies like Apple, see themselves as platforms. They don't see themselves as producing telephones. And I've noticed, I was in China 3 weeks ago, the only 2 iPhones I saw was my own and my boss's. So there doesn't seem to be a lot of increase in market share for Apple. But Apple sits with $230 billion worth of cash on the balance sheet. Buying Tesla at $520 will be equal to only 1 year's free cash flow from Apple. So if Apple doesn't buy Tesla, I guarantee you they will buy something else. because they cannot make money from selling phones. They need to be a brand, a platform. And then for us Europeans, probably the worst that could happen is what we call Auf Wiedersehen Mutti, which means goodbye mommy, which is what we call the German Chancellor Merkel. She has decided to step down. I think one of the worst positioned economies in the world to deal with the next evolution of technology, battery, cars, and the likes is Germany. So be very careful with Germany. So in closing up, I will say the following. I am the most optimistic I've been in my 30 years as an economist, but for one reason only. It cannot get any worse. Shishi.
Thank you, Mr. Steen Jakobsen. 感谢 Steen Jakobsen 先生的惊人预测。